Okay, the endlessly fascinating subject: financial planning models for the next 6 months, actually 7 months. So, how to make sure you trade profitably, or at least mitigate losses. I have to say that is probably the least exciting title that I've ever had to put, but obviously we are in extraordinary times, and really what I want to try and do is present a tool so that you can help to manage this next phase as we move out of lockdown and the government support finishes. So this tool is basically to help you to manage the money that you've got coming in. It's going to really then help to illustrate how lean you need to be. And if you've watched any of the previous videos or the interviews or whatever that I've done, you'll see that all of those successful operators at the moment are running and focusing very hard on being lean. It'll help you to predict the impact of takeaway sales and the social distancing rules, or at least gives you a tool to. It'll help you to illustrate what else you might want or need to sell, because your sales will be down probably when you open, and I say probably because it's actually not the case for everybody, but what else you might need to put on top of that so that you're not, as I say, you're not actually losing money every month. And then it'll help you to see what isn't worth your while. What particular extra revenue streams you might put on aren't worth your while. And this is the really kind of unpleasant one. This is the piece that this will show you whether you are forced to make redundancies, I'm afraid, as the whole furlough process eases off. It will improve your ability to deal with your landlord, particularly if you're having problems, because you'll be able to show this document or a couple of versions of this document that we've got, and be able to demonstrate that you need a bit more time. Now, that again is very variable depending upon your situation and your landlord. Likewise, it'll improve your ability to deal with investors or lenders who maybe are putting pressure on you or just need to be kept up to date. And finally, it will. Finally, it will actually help you to sell, should that be what you want to do. And I'm very aware that I'm actually helping a couple of clients at the moment to sell. I've had I just got an email last night from a client who has sold very quickly, actually. So this allows you to then look forward and think, well, actually, depending on my situation, maybe I want out. And it would then be a document that you could then use to have in place to make sure that you get maximum value if you are selling. And I know it is the case for a number of different people. So, as I say, this is just one tool. We've got a number of these. We've done some before. There are more coming. There are a whole load of resources that we have put together and are continuing to put together. So, if you click the link below, you will be taken through to a page that I'll show you an image of in a second, there's a new cut down version of 5 case studies that we have done, or that I did, and I've really deeply analysed what has worked for those folk and what you could potentially put in your business. There's then a piece of training about solutions that you need to be doing right now, very practical things rather than this financial management piece. There's the cash flow training, which you may or may not have downloaded before, but it gives you access to that as well. A reopening checklist, which is complete and will be out in the next day or so. Just working with the Caffè Culture guys in terms of the timings for that. And this particular spreadsheet that I'm going to go through today, you'll get that document, so that you can, as I say, apply it to your business. Plus, there will be new checklists coming out for when lockdown finishes, because obviously it'll be a different world. We still don't know, as I speak here today on the 17th of June. We still don't know necessarily. We've no rules, 1 meter, 2 meters, and the whole industry obviously is sitting waiting very nervously. So click the link below. You'll go through to that page, a little bit of a list out of what I've just said there. Click that green button, and then you will get access to most of that stuff, or about at least half of that stuff initially, and then the rest over the next few weeks as things progress in this ongoing kind of desire, both through me and through the Caffè Culture guys, to provide as many resources as possible. Right, okay, the harsh reality is that if you are if you're already open, or you are reopening, and we move into this lockdown or so post-lockdown phase where you're sort of expected to operate as a cafe as opposed to just takeaway, it is going to be really tough. You may very well lose staff. You may already have lost staff. You may have lost suppliers. The supply chain in general is really tough. I had a client trying to open the other day. Excuse me. I had a client trying to open the other day, and they just couldn't get open because they couldn't get supply. And some of the other interviews I've done, some people are saying that more than 50% of their existing supply chain is not available at the moment. Then we move into supply and demand, because if you can't get the supply, then the prices are likely to go up. So you've got to be aware of that. But again, this piece of training that we're going through here will allow you to work that through. And of course, the government support is going to stop. It's already, just on the edge of starting to taper off. And social distancing will reduce spend whilst keeping your overhead high. So the takeaway model at the moment can actually be very profitable, but when you're expected to open as a cafe, your overhead will go up, and it may be a lot less profitable. And also, to be honest, your customers may not be about, especially in office areas. So depending on your model, you just might not have customers around or have dramatically less around. And this model will show you how to make some assumptions over that. And you might also find, unfortunately, that if you've yet to open, your customers, your competitors may have stolen market share. That's categorically the case in a variety of places around the UK, and obviously on a worldwide basis, where people have taken that first mover advantage and worked it really hard. And as I say, make sure you go and sign up for that, because then you'll get to see all the previous interviews and all of those case studies where I show you how that works. And you could still do some of that yourself. This is joyful, but we are likely to be moving into the deepest recession of our time. And of course, just to really, really cheer things up, are we going to move into a second wave? So the point behind all of this is none of that's cheerful. It's all really quite unpleasant. But what you mustn't do is ostrich, as it were, put your head in the sand. You've got to do this piece of financial planning and actively review how profitable or not you will be. And I'm very familiar with, back in the very early days of my career, when of financial planning ostriching. And obviously I work with an enormous amount of clients and have done over many years, and I know a lot of people in this industry are very creative. They've got great joy for hospitality. They've got great joy for looking after the public. They've even great joy for looking after their people and developing them and so on. But it's the key thing that people ignore sometimes, or a lot of people ignore, is this financial planning piece. So I've tried to make this as simple as possible in a really easy to use document. So what we're doing here is a projected profit and loss, which is not a cash flow. As I say, there is a piece of cash flow training. Cash flow is essentially the money and how it flows in and out of your business, and what the projected profit and loss is, where the profit is what's left after all your costs are deducted. Now, you need to be managing and projecting both, because it's very possible to have positive cash flow and no profit. In fact, that's quite common in this industry, and it's a piece that people can get open, get credit, and from the suppliers, and not pay VAT for 3 months and all of these things, and have really quite strong cash flow, positive cash in the bank, but there be actually no profit or quite a hefty loss. And you can also have lots of profit but no cash. I've been in that position myself, and that can be the end of a business. Right now at this moment, your situation is going to be very different from everybody else, as this is the key thing, and that's why you need to do this kind of financial planning piece. So within the some of my paid members group, these are two radically different positions from two very good operators of a not dissimilar type. This is one. We've massively increased gross profit, reduced staff costs, and despite a little bit of a drop in customer numbers, the sales are up. I honestly can't believe it. So this is one person doing extremely well out of the current situation. and that will change whenever it moves forward. And this is unfortunately another client saying, early days, but doing in a day what we used to do in an hour is demoralizing. How is everyone doing? That actually was yesterday. So it says yesterday, it actually is yesterday. So that's just two extreme examples. Some people are doing very well. Some people are in areas where it's going to be really tough. I have a client in the real city of London, where the streets are still kind of empty, and that's going to be really tough. So that's why you need this. And to an extent, the key thing that I'm doing is with any of the one-to-one clients is actually this document is based upon what I'm doing with them. So this profit and loss is nothing more than your ability to manage the key variables. Okay, to manage the variables of what's the financial stuff that's going on in your business and actually how you generate that. Big three are sales, cost of sales, and total wage cost. Those are the three that you are managing on a day-by-day basis. And unfortunately, those are the three that are now likely to be extremely different. So we'll come to that, but those three, you when you open, if you are open, you have different rules. Your profit and loss is going to look different to last year, and that's what this is all about. Then you have rent and rates, and your general overhead. There's kind of the next three big ones, as it were, and then you have finance costs and taxes, etc. So we'll kind of go through all of those in separate pieces, but managing these key business variables is something that you really need to have intense focus on at the moment. It's more important than ever. And what we're finding, again, if you've watched those interviews, everybody that I have interviewed who has been successful and everybody that I'm talking to privately, it is successful, has really been digging deep into the figures, all sorts of other exciting stuff, but that's in other training videos. But this piece is, you need to manage this. You need to be on top of this as we move into these more difficult times. So first of all, sales. Your first of those big three, sales. They might be up, they might be down, but they will undoubtedly shift throughout the next 6 months. And this modeling process I'm going to show you allows you to manage that. So if you just open whenever, as it were, Boris says we are allowed to open properly, it's unlikely that your sales will be up. If you're already open and you've crafted a really strong takeaway delivery retail model, then you might have your sales up, but this model's about showing you how you can manage that. Cost of sales, right now, some people's cost of sales are up and some are down. People doing a lot of takeaway coffee, their cost of sales is likely to be down, but of course the spend is likely to be down too. And some people have a increase in cost of sales, but that's because they're doing all sorts of different items, not necessarily because they're discounting. It's because they maybe are they're having to buy at a more expensive rate, or they're doing a lot of retail stuff that is lower margin. So there's a process here that we're going to show you how you can manage all of those three things, so you'll be on top of it. And your business, as I say, will have its own issues. As I say, lots of pure coffee sales, lower cost of sales, higher gross profit, but lower overall sales. Right. The third key piece is the wages aspect, and I kind of keep thinking of this in my head as this furlough bubble, because right now at the moment, a lot of the reason why many people are operating very profitably is because all of their staff are on furlough, i.e. they're not paying them anything themselves, and they are maybe managing the business themselves in a very hands-on way, or with another member of the family, or with maybe one person off furlough, or one person who fell out of that furlough, the criteria for getting into it. So at the moment, it's slightly unrealistic, but of course, as you very well know, this is not going to last. This bubble is going to burst. And as I say, your wages might be down. The takeaway offer is extremely lean because there's no table clearing, dishwashing, etc. Most of your staff will be in furlough, and soon that will be radically different. Full service is likely to be expected by your customers, but you will have severely restricted tables. We don't know how much. And as I say, furlough going and other changes. Now, within the other documentation that you'll get through, we'll have links to all of the government information. But this is the actual page on the government website to explain the changes in the furlough system. So we have July, August, September, October, and you can see how it is shifting down. July is really when the start of the change happens. The furlough rate is going down. The level of contribution from the government towards employers' national insurance and pension contributions is all cutting away, and the level that you have to contribute to furlough all smooths out through. So this information is critical for you to have, and it sits at the bottom of the document as well, with the various links to, so that you can help to keep managing and understanding what your staff are going to start to cost you. Still a little bit of breathing space at the moment for the next couple of months, but we'll get to the figures anyway. Rent is wildly variable, but by nearly all, some landlords have been very generous and have actually stopped rent for periods of time, but generally only 3 months. Some of them have not stopped at all. Some of them are just desperate actually to take keys off people, but are being obviously prevented legally from doing that at the moment. But in nearly all cases, if it's deferred, it will need to be paid back. So we need to consider that within our projections. Rates, well, that's kind of the big bonus that you have at the moment, is that you've got full relief until April 2020. There is a possibility that may be reviewed in autumn, but I think it's highly unlikely. It's a strong promise. Now, your general overhead is all your electricity, internet, uniforms, cleaning, marketing, bookkeeping, accountancy, legals, insurance. The general overhead that sits, as it were, underneath everything. And one of the key things is that you've got to, you've under this new lean model, when you project forward in your business, it is my suggestion is that for most people you're going to have to be as lean as possible. So you need to really get the stethoscope out. You need to get the stethoscope out and analyze, if you could trim a little bit of all of those, some of those, then it is worth doing. I would be suggesting that you probably are not going to try and cut back aggressively in marketing. You don't want staff running around in horrible, messy uniforms, but there might be pieces of your general overhead that you can trim. So, the next piece then is actually your sort of finance costs, which again varies a lot, which is leases, your loans, interest that you pay, investor payments. And I know that I have a client who had a very large investor payment that had to be made within the first sort of couple of months of lockdown. And the investor has been very good, but you will have your own situations on that front. And finally, then the taxes aspect. It's worth bearing in mind that VAT is there is a deferral on your VAT at the moment, but that is actually only a cash flow item. So what we're managing this in terms of our profit and loss is not looking at the VAT piece. But you need to be really aware that it does still need to be paid. There has been a deferral of self-assessment, but we're now moving into pure accountancy speak, and I'm not an accountant. So look at the links and then speak to your accountant about that. Okay, let us have a look at the document. So what we have here is what we have here is, let me just go to the blank version of it. This is the document, and you've got, I have projected out for June, July, August, September, October, November, December, to the end of the year. Now, when you get this, actually, I put a little code in terms of how it works, but basically what you do is you enter in blue cells, some numbers, some projected numbers, okay? And you enter in percentages into the yellow cells. You don't touch you don't touch anything that's grey. Now, those are not protected at the moment. When I do an updated version of this, I'll send it, don't sign up for it. I'll send you out a protected version, which makes it a little bit easier then to manage. So this is obviously, this is very much a new document based upon the current situation that we're in. Now, what I have done to give you an understanding of this is let me just make that slightly larger, is that I have worked through an example, a sort of made-up example, so that you can see a fictional coffee shop and how we have entered this information in. So in this fictional coffee shop, what you do is at the top, you enter in last year's net sales after VAT. Your net sales after VAT goes in up here. And you do that for each of the months that you move across. And because that's what we're going to try and base our projections off. So we're assuming that you are at a certain level of sales. Now, obviously, if you were not open last year, as I know, obviously some people have just opened almost, I have a client just opened 7 weeks before the whole thing started. Put in whatever your projections might be. And then here you now enter what you believe your percentage of that will be. So in this fictional model, last year they did £20,000. I have said that in June it'll be 30% of that. So obviously, as you can see, if I change that to 40%, then that figure goes up to 8, and then the total net sales go up. Now, the issue here is this then allows you to look at. You can see. So I just pointed at the screen, which is kind of pointless for you to, because you can't see me do that. But as we move across, I have made some increases, right up to say approximately 75% of turnover in December. This is very much you are going to have to try and work that through yourself. So I'll give you an example of an actual client that is closed at the moment, will be opening in July. I think this is probably higher than it will be, but because they're in that real city centre piece in London, which goes so quiet in August, there is a likelihood that this could drop down again to that sort of a figure. And this kind of planning process allows us to look at all of that and think, well, actually, yes, as I'll show you, how much money are we going to make or not make? So you need to take your last year's figures, you need to then put in your percentages that you expect to be able to achieve as you move forward. Now, I've given you 4 tabs here so that you can do various versions of this rather than having to just work on one. Now, if you want to open on more tabs, you just copy and paste. So we're over here, and we have entered in our core sales for the core business. That's this row number 4. I've then put in another few categories because you might be doing some online sales at the moment. You might be doing some retail sales. You might be doing something else. Now, under this model, I've assumed that they're open. They're doing pretty low sales in terms of their normal cafe and takeaway sales, but they've got a little bit of online sales going on, which is quite common. And then I've projected that forward in terms of how much that carries on throughout the year. I've also said that they're doing some retail sales at the moment because a lot of people are. So that figure was sitting arbitrarily at £2,000 or dollars or euros. And that I have actually reduced down, as you can see, because a lot of those retail sales will drop off as you move towards better sales in your cafe, as you move towards reutilizing the space as a cafe or the coffee shop or whatever your model is. But that might go up. It depends how you reinvent your model. And then I've also put in another category of any other sales, such as catering or wholesaling. So I know a number of people, I had a conversation with somebody the other day who has now spent some of their bounce back loan money to put in a roastery and is intending to go wholesaling. Now, I think wholesaling is going to be pretty tough, but that then is somewhere along there they will be putting in a line for the revenue from that. But under this model, what I'm just saying is that basically this particular fictional cafe has decided to start that the figures were not big enough, that they were sitting at half their levels of turnover, so they wanted to start putting on more revenue streams and started to do some catering. So that is actually working extremely well for some people at the moment. Strangely well, considering a lot of the offices and so on are closed, and it is a model that I'm working through with some clients. I've done a lot of catering in my own businesses in the past. So this is about you working out your core business and what percentage you're likely to have, and then these other revenue streams that you may potentially already have or be putting in, and then projecting it out right through until the end of the year. Okay, so I'll come back to how this all adds up then afterwards. Then we move down to the cost of sales piece, which is all of this here. So what I've done is then on a similar basis, I've allowed you to put in from your accounts what your cost of sales was last year, as it was showing in your accounts, because we're going to do some calculations with that figure. Then you put in the kind of the expected or the achieved, if you're doing an ongoing profit and loss, which I think you should be, margins, the cost of sales margins that you've got at the moment. So I have said under this fictional model, because it's purely takeaway, that actually the cost of sales is lower for this first month, or for the month of June, and then gradually starts to improve. Next month it'll be tougher, and then it might start to settle back. Obviously these are just made up figures, but they are based on sort of lots of different versions of this that I'm doing for clients at the moment. Online sales have a higher a cost of sales. The retail sales in the shop are sitting at about 60% because there's maybe some grocery sales going on, and then that reduces. So you basically have an ability to reduce for every month, or manage every month, what you expect your cost of sales to be. As the model shifts away from takeaway to more sit-in, and the whole retail emphasis shifts, or the online goods that you're selling shifts, and you maybe move from something that has a lower margin to a higher margin. And then we've got the gross profit off the back of that. So we can see that the gross profit is sitting at a fairly low level, as a mixed gross profit for all of that across the board. Now, we then move down to the kind of your the rest of your overhead, and I've dropped this kind of into three categories, as I discussed kind of in the presentation there. So we've got our wages piece, and I've just made up figures, but you need to. This is actually where you've got to do the whole chunk of work here, because you've got to keep referring down to the bottom here, where I've put in A, the link to the government page, and B, an image of how this all works. And this is where you're going to need to have a look at your wages and think, okay, well, maybe at the moment, during this month, I'm paying £1,000 out to one member of staff. Next month, as we move through into the sort of post-lockdown, I've got to start taking people off furlough, some people off furlough, and then some more, and then some more. But then as we see, the actual furlough amount is reducing down to zero in November. So one way or another, your wage bill is going to go up. Now, in this particular business, what I've done is, you can just flick your way through it as well. I've assumed that this is a busy business in December. A number of cafes and coffee shops are like that. So they did 31 grand last year, still down in core sales, but because they've got all of these online sales going, and maybe maybe a catering arm, they have the ability in December to build that up together. You will know your model. Obviously, if you need help with this, I can certainly help you with this, but you need to sort of look at your model and think, what could you do? And as I say, check out the other trainings. We have these other trainings in terms of helping you to see what these various scenarios are that other people are doing, a real breakdown of what they're doing, and then you can start to look and see what of these other options you might potentially be able to put in your business. So back we go to the overheads. So the furlough piece involves you having to try and work out gradually who you bring back or not. It's tough to do, but as I say, I'm doing it at this very moment with certain clients. Now the rent piece, really what you want is, because this is a monthly profit and loss, you want to take last year's rent, or whatever your rent is, and just divide it by 12, regardless of when you pay it. So as I say, this is a profit and loss rather than a cash flow. In a cash flow, you'd be putting it in when you're actually paying it. In a profit and loss, you're putting it in so that you can see the actual profit that you're making at the bottom on a monthly basis, or a weekly basis if you want to do it that way. But this is just set up monthly. And what I've done is I've just sort of made an assumption that the rent is, what would that be, 36 grand a year? 36. But I've made an assumption, yes, that as you can see here, that it goes up in September, October, November, December, because maybe the landlord is pulling that little bit back. Now, you could argue that from in pure accountancy terms might need to be treated differently. I think in terms of a realistic terms, you want to put it in here in your profit and loss, because you can't appreciate that. It's just going to affect your profitability. So you will know your figures, and you've got to put it in there. As I say, I put in a 0 for rates. Now, this is where you need to enter in your own figures based upon all of your existing costs. You have a few extra categories that you can put in here as well. So The way to do this ideally is that you take last year's costs, you take your profit and loss from last year. Or if you're doing monthly management accounts, you just drop the figures in here. But then, as I say here, review. And I mean, you really have a look at it and think, what can I do to reduce any or all of those? There are a couple of difficult things because your accountancy bills actually may be going up. Your bookkeeping bills may be going up. Maybe you're doing your own bookkeeping. You got various other things will be down. Your cleaning costs and cleaning materials, I'm afraid, are likely to be up. So your general overhead is likely to be up. So what I've done is I've literally just put in £3,000, and that represents give or take 15% of the turnover, which is about. It's average-ish. I always like to be a little bit less than that, but that's about average-ish for what I would expect for clients when I go through profit and losses. And I probably go through 30 or 40 profit and losses a year and have done for over 10 years. So I just see an awful lot of these. So it's a not unrealistic figure. What I'm saying is use this shouldn't take you too long to go through this, but use this to go through and actively look at all of these things. Then you have a total payments out, and then you have your EBITDA, your earnings before interest, tax, depreciation, and accruals, which is your core kind of net profitability. You have your proper net profitability at the bottom after the finance piece. But at the moment, I have just made some assumptions in that. So in the finance piece, I've literally just put in depreciation of £500 a month. You probably want to have a look at your accounts from last year to come up with that figure. Likewise, put in your bank interests, any other leasing costs. We're starting to move into, again, a more kind of financial piece. And a lot of these conversations, if you really want to go to this extent, you want to be having with your accountant. As I say, the way that the profit and loss works is it doesn't have the sort of repayment of, it has interest repayments, but it doesn't have repayment of capital or anything like that. So to an extent, this is important down, if it's incredibly important down here, but all accountants treat these in slightly different ways, primarily to control your taxation. And I'm not saying that they're doing that entirely legally. Well, 90% of the time, 95% of the time, they're doing that legally. But your accountant will be treating these in slightly different ways. All accountants depreciate slightly differently. And as I say, I see just so many of these. Your interest is what your interest is. And you may have lease costs, you may not. And lease, of course, is treated in a different way to sort of hire purchase and so on. But let's not get stuck on that. So if we move across here, then we start to see then kind of the analysis that you can look at a bit more easily. So these total net sales here are so it's supposed to be conditionally formatted. If I conditionally format, I'll show you how to do this actually, just in case you don't know how to. So actually, no, this is conditionally formatted. I've already done it. So conditional formatting is where you attribute a sort of a rule to a cell to go red or some sort of a color to highlight a difference away from what you would like. And this is where if you push this across, we can see that your sales were 77% of what they were in that period last year. That's what that works out, because your total sales were 131,000, and it's red because it's less than that. Now, if I just remember, enter into blue cells, enter percentages in there, don't touch these. If I enter in here, let's say £50,000, this will go to a normal color. So you're ahead of the game. That's not going to happen, but that's just showing you how that particular piece of it works. So then we move down to cost of sales. So we know that our overall sales are down, regardless of all of these other pieces that we've done. In this model, this is purely theory at the moment, so you would work through various versions of this or play around with the same one. Now we look at the cost of sales. We've looked at all of these different kind of blended cost of sales, so you have a blended margin, and we see that your cost of sales last year was 30%, it's now 35%. And again, that's conditionally formatted because it's above that. So, you're going to know if it's above it anyway, but it's just a useful little tool for it to be highlighted out to you, the differences that you're going to have. Now, you put in last year's wage cost, which I'm saying is, say, 38%, plucked off the top of my head, but not unreasonable for a business that's kind of making everything from scratch. And this year, because of the inefficiencies of the business, as the furlough drops off, you might be more efficient to begin with, very efficient to begin with, and then very inefficient if you don't make redundancies towards the end. So we know that 47% is your percentage of wage cost versus the 38%. So we see this is where it gets tough, because what we've got here then is the situation that you're going to be looking at this, on a kind of a month by month basis and thinking, right, okay, this is not adding up. Do I have to, when the furlough is completely removed or whenever this starts to become overhead, am I going to have to make redundancies? Some people out there are making very, very, very strong commitments to their staff in terms of no redundancies, and that I have just the utmost respect for, but that's generally for businesses that can't afford it. You need to make your call on this piece yourself. You need to make your call on looking at these figures here and making sure that you have a business that can survive. Or you make the call and think, right, okay, look, I really want to make... The advantage of making very strong commitments like that is it then makes you go back up here and think, okay, what can I do? This is the key line. What can we do is the key line, that when you watch those interviews with the folk that are open and trading profitably at the moment, that so most of them were in a certain situation where they were maybe falling out of the cracks in terms of government support, and that's the line or variations on lines that they are saying. So if you can try and avoid making people redundant by being very creative, as it were, over here, then hopefully you can start to make it fit and really build that loyalty with the staff. And of course, that is what I would always advise, that you look after your staff. I am acutely aware that these days, when I'm not actually operating, although I will be operating as an operator again soon, it's easy for me to say that. It's the sort of commitment I would have wanted to make, but I'm not making any judgment on you. The point that I'm making is this document is about letting you see in black and white and red, as it were, what it's going to cost you to bring the staff back. So you've got to work your own figures out. I could have made this vastly more complex in terms of then entering in all of these rates, but at the moment you've got to sit there and do some calculations to work out what your staff are going to cost you when they come back and how well you can manage that. So because, as I say, also this rent cost is way more than it originally was. Sorry. Yeah, that formula is wrong actually, so I'm just going to change that right now to, just so that I don't forget, to 8. Oh. Sorry about this. The Q9 is what we want, because that is representing what our rent is in percentage of the turnover. And as you're probably aware, the target that you're always looking for is 10% or less. So under this model, as you're paying all of this back, you've got to, you're being hit by higher wage costs, lower margin, higher rent, and and then you've got this level of overhead as well. So all of these payments out, all of this overhead, and I put in this arbitrary sort of £1,000 a month owner's salary, which is very common from a tax perspective. You need to put, as I say, fill this piece in yourself. Now, under this model, we've gone from what was probably a relatively profitable business. You can see how all of these figures together have eroded the situation down. I don't know, I'm laughing. Situation down, despite a very busy December, to 0. So we've got a 0 level of EBITDA profitability. Then you take the financing costs and depreciation and so on, and it goes negative. Now, if you are just negative by that amount, I think in many cases that's probably okay for this period of time in terms of the survival. But that depends hugely on how much of a cash bubble cash reserve you've got, for whether you've still got loans left, or any of your grants left. So this is about you at the moment. Most people are sitting there with some cash reserves in the form of grant, in the form of the £10,000 or the £25,000 grant, or the bounce back loans. So, but what we really don't want to be doing is burning through that in terms of profitability. That's what this piece is about. It's about letting you see how you can actively not burn through that. I will check these formulas again just before I put this on through. So that's what this is about. You then go through to your own, you put through your own figures, as I say, blue, put numbers in blue, don't touch the grey, put percentages in there, and then work it through like that. And if you have any particular problems with that, make sure you're in my Cafe and Coffee Shop Owners group, and I can maybe answer them in there. But if they're broader problems, I can certainly help you on a more one-to-one basis, or in some of the paid programs we have. So thank you very much. Make sure you click that link below to get all the rest of the resources, and certainly to get this at the very least. And we will have a lot more training, practical training, and as well as sort of I suppose more interesting training in terms of the how to actually as it were do this piece, how to actually build the sales as well. So thank you for your time.